A 100-year record of U.S. stock market. The U.S. stock market has gone through tremendous changes over the past 100 years, standing at the center of the global economy with remarkable growth. From the Great Depression of the 1920s to the technological revolution of the 21st century, the U.S. stock market has provided huge opportunities for investors. Of course, there have been several recessions and crises along the way, but in the long run, the U.S. stock market has been steadily rising, providing investors with high yields. In fact, the average annual return on the S&P 500 index is calculated to be about 10%. As such, the U.S. stock market has been an attractive investment destination for long-term investors. However, some investors are reluctant to invest in stocks due to concerns about short-term market volatility or past experiences of crises. But if you look back at the 100-year history of the U.S. stock market, it clearly shows how important it is to maintain investment in the long run. Of course, past results do not guarantee future returns, but historical data can help investors make investment decisions with confidence. In the 1920s, the U.S. stock market entered its golden age. After the war, the economic boom continued, and many investors entered the stock market, and the stock price rose day after day. But in October 1929, the stock market experienced a major crash. On this so-called Black Tuesday, the Dow Jones Industrial Average fell by more than 12% in just one day. This signaled the beginning of the Great Depression, and in the years that followed, the economy suffers from a severe recession. In the 1930s and 1940s, the U.S. stock market was hit hard during the Great Depression, and many companies went bankrupt. The government tried to revive the economy through the New Deal, but the stock market remained unstable. With the outbreak of World War II in 1939, the economy was reinvigorated by war industries, which also had a positive effect on the stock market. During the war, the U.S. succeeded in rebuilding its economy, transforming itself into a giant munitions producer, and the stock market slowly began to recover. After the war, the U.S. enjoyed a post-war boom. The 1950s and 1960s were periods of rapid economic growth, and many people regained confidence in the stock market. Technological advancements, especially in this period, greatly affected the stock market. Advances in computers and electronics led to the growth of new industries, and technology stocks began to gain popularity in the stock market. Technology companies such as IBM and Texas Instruments have grown rapidly during this period, bringing high returns to investors. The 1970s were periods of economic instability. Political instability, including the Vietnam War and the Watergate incident, had a negative impact on the economy, and two oil shocks in 1973 and 1979 shook the economy significantly. Oil prices soared, inflation rose sharply, and unemployment rose. This economic instability had a major impact on the stock market as well, and stocks remained on the decline. Defensive investment strategies were noted during this time, and safe assets such as gold became popular. By the 1980s, the U.S. economy was showing signs of recovery. President Ronald Reagan's economic policies were market-friendly, and policies such as easing corporate regulations and reducing taxes had a positive effect on the stock market. Also, the information age, which began in the late 1980s, breathed new life into the stock market. The spread of personal computers and the development of the internet caused a tech boom, and tech companies such as Microsoft and Apple grew rapidly. In the late 1990s, the dot-com bubble overheated the stock market, which led to the bubble collapse in the early 2000s. The early 2000s started with the dot-com bubble burst. Technology stocks, which had surged due to excessive expectations and speculation, fell sharply with the bubble burst. Many tech companies have gone bankrupt or undergone major restructuring, and the stock market has also been hit hard. In the mid-2000s, however, the stock market rose again with the housing market booming. However, the 2008 global financial crisis is once again causing a major crisis. The financial crisis triggered by the subprime mortgage crisis has shocked the economies of the world, and the stock market has fallen sharply. The 2010s were a period of recovery after the global financial crisis. Thanks to the central bank's quantitative easing policy and the government's economic stimulus, the economy slowly recovered, and the stock market was back on the rise. During this period, the technological revolution especially affected the stock market greatly. The spread of smartphones, the development of social media, and the emergence of cloud computing and artificial intelligence drove the growth of new technology companies. Tech giants such as Apple, Google, and Amazon led the stock market with soaring market capitalization. The early 2020s saw the world hit hard by the COVID-19 pandemic. Stock markets fell sharply in the early days of the pandemic, but recovered quickly thanks to the central bank's aggressive monetary policy and large government spending. In particular, the growth of non-face-to-face industries and technological innovation drove the stock market. After the pandemic, the stock market has been stabilizing along with the economic recovery. The Dow Jones Industrial Average increased about 593 times, from 6498 in 1896 to 589.16 on June 14, 2024. The average annual return is about 5%. The S&P 500 index increased about 247-fold from 2192 in 1926 to 431.60 on June 14, 2024. The average annual return is about 10%. The Nasdaq Composite increased about 197 times from 8947 in 1971 to 17688.88 on June 14, 2024. The average annual return is about 18%. The U.S. stock market has undergone numerous changes over the past 100 years. The U.S. stock market has steadily recovered and grown despite numerous crises such as the Great Depression, World War, oil shock, dot-com bubble, and financial crisis. This history offers important lessons for investors. The stock market is sensitive to short-term volatility, but it tends to rise with economic growth in the long run. In addition, it should not be forgotten that structural changes such as technological innovation have a big impact on the stock market. Therefore, it is important for investors to take a long-term view, look carefully at changes in the economy and technology, and set up investment strategies. Please subscribe, notify, and like. For me, producing videos, it's a great help. Thank you.